If we ask Google which are the best books about investing, you will get this list. The first book is The Intelligent Investor. Interestingly, I remember that Warren Buffett talked about that book.
When I read the book, The Intelligent Investor.
But then again, that book was published in 1949. It was time when US dollars was based on gold. So let's mix in our most recent books, at least 1,000 reviews and 4 to 5 stars. So, 12 books in 16 minutes.
I have a rule about investing. I never let a single stock become more than 5% of my portfolio. I never let a sector like energy or technology become more than 20%. This includes real estate. I once had real estate up to 31% of my portfolio because I love real estate.
In other words, don't put all your eggs in one basket. Kevin O'Leary prefers 20 to 30% in sector and 5% of a stock within a sector. But we can see that Warren Buffett put 50% of Apple stocks in portfolio, and Bill Gates placed 50% of his portfolio in 2 stocks, Microsoft and Berkshire Hathaway. So takeaway is, don't depend on one sector or one stock. Next, we don't pick stocks, we pick companies.
When I was 11, I picked stocks. I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down. And the first 8 years, I thought the important thing, predict what a stock would do and predict the stock market. And then I read Ben Graham, The Intelligent Investor, and I realized that I was doing it exactly the wrong way. I rejiggered my mind, and from that point, I never bought another stock. I bought businesses that happened to be publicly traded. I became an owner of a business. I did not care whether a stock went up or down the next day or the next week or the next month or the next year, and I didn't have any idea what it would do. I didn't know what the stock market would do, but I knew businesses.
First, we must realize that we are not in the same position as Warren Buffett. He had 7 partners, and they accumulated $105,000. Of course, that was in 1956. In today's money, they had more than $1 million. So if you have $1 million, we need stock that will pay dividends monthly or quarterly to reinvest. It's too slow with half-year and year dividends.
It's crazy to own 50 stocks or 40 stocks or 30 stocks probably. In fact, I've told students if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich.
So, which 20 companies would grow your portfolio? Let's imagine company A that makes $100 million per year in profit and gives 10% as dividends to investors. That would be $10 million. And let's imagine a company B that makes $1 billion per year in profit, and they give 2% as dividends to investors. That would be $20 million. So we can see that cash flow is the key, and dividend percentage is secondary. Next, how to tell if a stock is overpaid or undervalued with PE ratio, price to earning. Investor would refer to 20 to 25 as average PE ratio. But the best way to understand PE ratio is with examples. So let's imagine company C, with share price is $50 and earning per share is $10, which means they have PE ratio 5. And let's imagine company D, with share price $50 and earning per share $5, which means that PE ratio is 10. Which means with PE ratio 5, it means you bought business for $5 to earning $1. And PE ratio 10, which means you pay $10 to earn $1. Over time, it will pay. However, it tells us also that lower PE ratio is better. And that will explain that copy and paste Buffett stocks is a bad idea, because he bought these shares when they were undervalued. Buffett bought Apple stocks in 2016 at $24.91, and he bought Coca-Cola stock in 1988 at $2.45. So the point is, we have to find undervalued businesses and are in expanding market. The next question is, where do we find businesses that have cash flow and are undervalued and are in expanding market? We will find it using Maslow pyramid. Maslow was an American psychologist who proposed the idea called Maslow hierarchy of needs. aka Maslow pyramid. And it's very simple. First, everyone needs to drink and eat daily.
And I form an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570 million. So annually, $6,570 million from 1 penny. Do you think Coca-Cola is worth a penny more than, Joe's Cola? I think so.
In fact, Bill Gates bought a lot of farmland.
Once you've consumed it, once you've consumed your drink or your snack or your pet food or your cosmetics, you have to go buy some more.
Did you know Logan Paul's worth about $245 million? It's not YouTube revenue. It's not even all the fights that he's made. That is going to lead to him being worth a billionaire plus. And that is he launched this. Prime is the number 6 largest beverage now in its sphere.
So the point is, we do not guess. We know for a fact what people need. And if we look at Maslow pyramid, when you see it, you cannot unsee it. When we see that major investors are invested in food and drinks, then we understand its basic needs. Food and drinks have cash flow because we know that population is expanding. Next in Maslow pyramid is warmth and rest. In other words, real estate. Lots of people made millions in real estate. In fact, 2 books from our list is only about real estate. How to rent and get tenants. But it's not so simple.
If you tell me the renters are going to pay the payments for you, that tells me you've never managed rental property. Renters don't pay. Sometimes there's car wrecks and job loss. Sometimes there's a pandemic. Sometimes ... I
don't know if there's any electricity. Yeah, wow. Is there any electricity, please?
So long story short, there is a risk. There is a risk in what you invest. So if you bought a house for $2,000 or more and your tenant damages your place, it's your problem. But if you invest in REIT, Real Estate Investment Trust, it's different. The company will take care about it. No more mess for you. But when Forbes lists 10 best REIT investments, it means it's serious. So let's end real estate chapter with a chart from JP Morgan. 20 years annualized return. And we can see average investor 2.9%, S&P 500 7.5%, and rate 10%. At the end, do your due diligence. Next step is Maslow pyramid is safety needs, personal security, employment, resources, health, and property. In other words, money. You need employment to make money, which means you need bank account and cards, and we can see it.
A bank could be a perfectly decent investment. In fact, Charlie and I, well, me originally in 1969, we bought a bank at Berkshire, and we had $19 million invested in that bank, and we had $17 million, I think, invested in our insurance companies. And if the Banking Holding Company Act of 1970 hadn't been passed, we might have ended up owning a lot of banks instead of a lot of insurance companies.
Banks and card companies, they have a large cash flow, and they're expanding because more people need more bank accounts. Next step is Maslow pyramid is love and belonging, friendship, intimacy, family, and sense of connection. So how do you connect with friends and family? With mobile phone. And we can see that Warren Buffett bought a lot of stocks of Apple. And next step in Maslow pyramid is esteem, respect, self-esteem, status, recognition, strength, and freedom. In other words, ego. Ego requires luxury things. For example, Apple. The problem is, lots of people cannot afford to buy BMW or Mercedes. However, they can afford to buy Apple iPhones. In fact, Bernard Arnault said, luxury goods are only area in which it's possible to make luxury margins. So we can bet for human ego to buy luxury things.
Miss Dior, the new eau de parfum, Dior.
Gucci Bloom.
Yves Saint Laurent.
A fragrance beyond the lines.
Hermès.
So again, we don't guess. We know people need and what they want. Next, how to find stocks that are undervalued. Let's look into 3 methods. First, with Piotroski score. Joseph Piotroski is American professor of accounting at Stanford University. He used historical financial statement information to separate winners from losers, and his method was proven. In fact, if you type in Google list Piotroski, you will see the suggestion of a list of companies with high Piotroski score. It means more people ask the same thing, and Google will provide multiple tools such as Trendline, screeners, and others. So we can see the list of companies with their Piotroski score and their PE ratio. And let's make sure the stocks belong in Maslow pyramid because they will last. Otherwise, lots of stocks can explode and then decline. For example, social networks. There was a time when MySpace was a huge, and now it's almost gone. Facebook is declining. In fact, Facebook changed its name to Meta, and yes, Meta bought some social networks like Instagram. But Facebook, later Meta, never paid the dividends. So it's good for stock traders, but not for investors. The second method is described by Peter Lynch. He achieved a 30% annual return. He doesn't like dividends. He wrote, "I'll take an aggressive grower over a stodgy old dividend payer any day." He said, "Use the power of common knowledge and keep away from trend followers. Something that is disagreeable could make lots of money. For example, we know the population is growing, which means more funerals, more flowers, more caskets." In fact, he found a boring company called Service Corporation International. They are funeral operator, and they own flower shops and casket distribution centers. Next is waste management. We know that will be more waste. In fact, Bill Gates has a stock of Waste Management Inc. The problem is, it's hard to find the disagreeable companies. However, by his quantitative filters, like PE ratio, growth, and such, there are a screener that lists the companies that match his criteria, and the links are in the description. The third method is from Joel Greenblatt. His magical formula earned him a 40% annual return without dividends. This is a different approach to investing. In his book, The Little Book That Beats the Market, he described a market. Over the short term, Mr. Market acts like wildly emotional guy who can buy or sell stock at depressed or inflated prices. Over the long run, it's a completely different story. Mr. Market gets it right. So it's all about PE ratio and return on assets. But the best part is, there is a simple 7 steps to use his book. Step 1 is, go to magicformulainvesting.com. There is a link in the description. Step 2, choose company size with market capitalization of $50 million and up. Step 3, get a list of top-ranked Magic Formula companies. Step 4, invest only 20 to 30% of money you intended to invest during the first year. Buy 5 to 7 top-ranked companies. Step 5, repeat step 4 every 2 to 3 months until you have invested all the money you have allocated. After 9 to 10 months, this should result in a portfolio of 20 to 30 stocks. Step 6, sell each stock after holding it for 1 year plus few days for tax purposes. Use all the money from sale to buy new stock from step 4. Step 7, continue this process for many years. In fact, Greenblatt continues with the same process to this day. Of course, any investing implies a risk, but 2 types of investing are less risky. First is index funds.
The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them, but they don't have to, because if they can buy all of America through an index fund. And then they just have to be sure they don't jump in at exactly the wrong time, and they won't know what's exactly the wrong time. So therefore, they should put their money in over a period of time.
Second is investing in art. Currently, it's more profitable than S&P 500. On masterworks.com, we can see that they have more than 700,000 of members and more than $700 million. There is a link in the description. It's very important to realize that there are different investors. Some are 100% into real estate. In fact, Robert Kiyosaki will tell point blank that he wouldn't touch stock.
I wouldn't touch a stock. I don't touch mutual funds. I don't touch ETFs.
Some are into stocks and dividends, some into the stock but not dividends, and some are mixing in. For example, Karen O'Leary, real estate and stock. The conclusion is there are more ways to invest. The fact is, every year there was a crash, some bigger, some smaller. But it also means that high prices of stocks has lowered. At this point, it's time to buy. After the crashes, there are new millionaires.
Because the last time we had like a big crash in the U.S., I made so much money. It was ridiculous.